The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Stocks down and bonds turn higher as the big October jobs report and the upcoming election loom over markets, kind of like ghosts on Halloween. Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Bonnie Quinn, and we are counting you down to the closing bells here on this Halloween. And happy Halloween to you,
Happy
Scarlett.
Halloween. Are you dressing up later on?
Well, I'm trying to figure out what I'm going to do because it is definitely Nightmare on Wall Street today.
There you go.
Maybe I will dress up as something a little scary. If you weren't scared enough already by this day where we're seeing the S&P 500 move more than 1% for the first time in 30 days. So there were 29 days where it didn't move more than 1% in either direction. It's definitely doing that today. Now, you could say it's a bloodbath, or you could say people are just taking profit and they are getting out of risk before the election and everything else that's happening next week. So depending on where you stand, if you were a buyer or a seller today, then maybe you're actually quite happy. S&P 500 down 1.5%. The Mag 7 index down more than 3%. The SOX is down more than 3%. The companies that reported yesterday, Meta, Microsoft, they're down more than 4% apiece. The companies reporting later, you get the drift. The VIX index is elevated. We're still below 23, so there could be potentially more to go, or maybe we're getting it all out of our systems today. And then the Philadelphia Gold and Silver Index down about 2.5%. Gold itself is just about 2% off its record. It has tripled this year. The dollar is also quite strong. It's had one of its strongest months this year, Scarlett.
All right, well, let's take a step back because today's batch of data really raised more questions about future rate cuts. The Fed's favorite inflation gauge, core PCE, showed a slight pickup while personal spending rose more than expected and jobless claims fell to a 5-month low. With non-farm payrolls due out tomorrow, Morgan Stanley's Seth Carpenter says the labor market is where it needs to be.
If you look at the job openings data from where it was when the labor market was tightest, you have to say there's been some cooling. So I think in that regard, they're fine. The pendulum had swung a bit too far. People got a little bit too breathless over a couple of months of jobs data. We're not deteriorating.
And the string of positive economic data has left U.S. Treasuries on course for their biggest monthly loss in 2 years. Meantime, we see stocks selling off following disappointing outlooks from Microsoft and Meta. The equity bull market takes a pause in October as investors brace for next week's presidential election. But this afternoon, investors are squarely focused on Apple, one of the last Mag 7 names to report. Its numbers will give a peek at how the new iPhone 16 with AI features is selling. Amazon and Intel also joined the earnings parade, providing a read on the cost benefits of investing in AI. And Vani, the key word there is cost, because that comes back into focus again with the latest inflation data.
Exactly. And of course, it is the biggest earnings week this season. As you know, Scarlett, you've been reporting on it all week, but there are also so many more cross currents. Obviously, the AI election is a huge one. We have China stimulus potentially getting a number next week as well, which comes towards the end of the week. And then, of course, you have the Fed meeting, which is also a massive, massive meeting. Here were some of the data that we got today. Pretty benign all round, but I just wanted to point to the inflation data because, as you can see, the headline inflation data, we are inching ever closer towards that 2% level that the Fed wants to achieve. However, if you look at core and super core, which includes shelter inflation, better news last month, but we are still at 3.23% when you look at that super core inflation data. It all brings up the question, is the Fed free to move another 25 basis points at the next two meetings? Should there be a pause? What happens with the non-farm payrolls tomorrow? Today's Labour Department data was pretty benign, as was the employment cost index. So it's all to play for, and the Treasury market is certainly having a very close look at these numbers, Scarlett.
Absolutely. And let's start right there, Vani. We're going to kick things off with Mike Contopoulos. He is Director of Fixed Income and a Portfolio Manager at Richard Bernstein Advisors. Mike, great to see you.
You too, Scarlett.
We're closing out October. The theme this month really has been the significant repricing of Fed rate cuts. Are you comfortable with what the market is pricing in, which is fewer than 2 quarter-point cuts through the end of the year?
Absolutely. We thought for quite some time that the market got ahead of where the Fed was ultimately going to end up. As such, we actually reduced duration leading into the last Fed meeting. And from our perspective, listen, the economy is really, really strong. I think you saw that today with the jobless claims data, yesterday with the ADP data. There's no real slowdown, no recession. If anything, the economy, you could argue, is reaccelerating. Profit growth is strong. And so I don't know if the Fed needs to cut it all. With that said, they will because they want to and the market's giving it to them. But it wouldn't surprise me one bit if they skip a meeting this year and only end up with another 25.
You mentioned the strong data. What surprises everyone, including apparently economists themselves, is just how well the economy continues to hold up. You look at the Citi Economic Surprise Index, it's now at the highest since mid-April. It really is like a straight line up. What is everyone getting wrong, including the Fed, and why are they getting it wrong?
Yeah, this is a great question, Scarlett. I think there has been a real lack of understanding of the restrictiveness of policy. You know, when the Fed looks at if they are tight or if they're loose in terms of monetary conditions, what do they look at? They look at the real Fed funds rate, and they look at where they are with respect to some level of the neutral rate. And both would suggest that they are tight. The fact that inflation has come down has been confirmatory to this view that they actually have tight monetary policy. The problem is inflation was probably going to come down regardless. Just because the year-over-year comps started to get easier, you know, a lot of the bottlenecks around COVID and sort of the COVID distortions started to dissipate. And so I don't think you've had a fall in inflation and a modest rise in unemployment because the Fed is so tight. I think that would have happened regardless. In fact, I think corporates have termed out so much of their debt at low interest rates. Mortgages are no longer variable rate, but rather fixed rate 30-year debt for quite some time. And the consumer repaired their balance sheet so much post-COVID because of all the fiscal stimulus that higher rates just isn't affecting the economy like it has in the past.
What numbers would you have to see tomorrow, Michael, for it to change the calculus for the Fed? So, for example, Citi looking for just 90,000 created with the hurricane effects, obviously, and the strike effects. But Mizuho still looking for 180,000.
Yeah, I think you'd have to see something well north of 100,000 to cause the Fed to pause. So I think the presumption is that they will go 25 basis points. And if you got 100, 150, 200,000, maybe you get a pause. But I think at this point, 25 basis points is pretty much baked in. And the number, I actually take that back. Probably not 100, probably well north of 200 for them to pause in November.
The bar is high.
The bar is high. They won't do more than 25. In fact, I think almost regardless of what the number is, unless you have a negative jobs print, it's probably going to be somewhat of a hawkish 25 basis point cut. If
you're baking in a 25 basis point cut next week, fine. Is there an election agnostic trade that goes along with that?
Listen, I think from a election perspective, here's the way I would think about things. You're going to have increased volatility, which we've seen more recently anyway, particularly in the rates market. After the election, my suspicion is regardless of who is elected, that will start to die down. Much of the recent rise in yields, I think, has to do with strong economic data. Some of it has to do with the potential that President Trump comes back into office and his policies could be inflationary, particularly around additional tariffs. But if he's elected, that move has happened. Mm-hmm. If Kamala Harris is elected, well, then maybe you didn't need to go up so much in yield. So I think you get some volatility over the next week or so until the election. But once the election passes, we're going to trade right back on fundamentals and economic growth and inflation.
You talked about reducing duration before the last FOMC meeting. What are you going to be doing before this next FOMC meeting?
Yeah, not much. I think we're very comfortable with our duration. So the Bloomberg Ag has a duration of roughly 6.2 years. We're a little bit about 5 years. It's not that I think clients should not have any duration and any interest rate risk. I think you need to have some interest rate risk here, just less than the market. I'm pretty comfortable with where we're at. Although we see profits accelerating for the next couple quarters, you are probably later in the economic cycle. When you get later in the economic cycle, and as the Fed remains tighter than what the market expects, I think you could, you're probably not going to go up that much higher on yield. So we're pretty comfortable with where we are today.
All right, good stuff. Mike, always a
Thank
pleasure
you.
seeing you. Mike Contopoulos is Director of Fixed Income and Portfolio Manager at Richard Bernstein Advisors. Now coming up, investors wrangling up shares of Kantoor Brands. There you go. After the parent company of Wrangler, Lee, and Rock & Republic jeans beat earnings expectations. It is Kantoor Brands. What the denim brand sees direct-to-consumer upside through next year looks like.
Plus, shares of Uber hitting speed bumps after the rideshare giant reported muted bookings in its core U.S. rides business. Why record operating profit just isn't enough to impress investors.
Nothing is these days, And Uber might be seeing muted bookings, but Booking.com is hitting a record high after beating gross bookings expectations. A conversation with Glenn Fogle, the CEO. We're breaking all the biggest earnings stories of the day and more coming up. This is The Close on Bloomberg.
Kantoor Brands are up 13% after reporting third quarter revenue and adjusted earnings per share that beat expectations. The apparel company's portfolio holds some iconic consumer brands like Wrangler, also Lee jeans. Their CEO joins us now. Scott Baxter, CEO of Kantoor Brands. Welcome to the program. And you're in Wrangler, as I see, so well done for that. So congratulations on the quarter. Talk to us a little bit about what was so successful this quarter, including the mechanics of Project Genius that you have unfolded.
Sure. Thank you for having me. We had a really strong quarter because we're taking share in the marketplace. This will be the 10th consecutive quarter that Wrangler has taken share, and we use a service that measures that, of course, in our wholesale channel. So we're really proud of that. Our product is really good. We had a couple of big kickoffs. We had Lainey Wilson and her collection that we kicked off, and that was just a really big success, and a couple of really strong collaborations. So a really good quarter related to that, and happy about that. And then also we talked about the fact that we see that continuing here in the fourth quarter and into next year, which is a real testament to the strong team that we have. And then from a Project Genius standpoint, we're $100 million in savings, and it's really focused on us becoming a more efficient company. We spun off from our parent company 5.5 years ago, and we just kind of did a clone and go on our back end, supply chain, global sourcing. And now we're going to go ahead and kind of make sure it's ours, that it fits us and it fits with what we want to do. And that's going to be a project that we're really, really rolling out here towards the end of the second half in 2025, and then we'll really start to see the benefits throughout 2026. So big project, really important, very timely, and helps us to become a company that's operating the way that we want to operate post-spin in where we are right now in the evolution of our company.
Scott, what are the dynamics when it comes to cost inflation? So freight, for example, labor costs, any surprising reliefs or the opposite?
We've had it's mitigated a little bit, as you know, and so it's been a pretty good opportunity for us this past 9 to 12 months relative to that. So inflation has waned, interest rates are going down, so the environment's been pretty good. Consumer seems to be in a pretty good place. We offer a very good value, so from a price point standpoint, it's a great set of brands offered at a great price and great value. So for us right now, the operating environment is not bad.
Not bad. And one thing that we should point out when it comes to the operating environment is that everyone in retail wants to bypass wholesale and go straight to the consumer. Wholesale works for you. Why does it work for you? And how much of it is knowing your retail partner and your consumers really well and working within those parameters?
Yeah, you're absolutely right. From the spinoff on, we have strongly partnered with all of our wholesale, partners, and they're great to us, right? They give us really good real estate, promote our products within. Our consumers are trained to buy our product there. They bring in new innovations. They'll bring in new products, which is really helpful for us as we introduce things. Our products are working for them, so it's a quid pro quo. We're driving traffic in their stores because the consumer wants our product, and we're bringing them a good value. Mm-hmm. So it really works all the way together. We have a nice balance, though, in that we have our own D2C globally, and it's just at a nice mix right now between our wholesale partners and also how much we have from a D2C and a digital standpoint. Because I'll tell you what we have found, where some people went all in on digital, we never did. We found that the consumer wants to continue to shop, and the balance that we have right now is very nice.
Yeah, absolutely. And I think a lot of the companies that did bet a lot on DTC are kind of trying to unwind that a bit here. You mentioned the spinoff. Kantoor was spun off from VF Corp about 5.5 years ago. You've been candid that it's because VF Corp didn't want you. They wanted retail-minded and lifestyle brands like Vans or North Face. What does being a standalone company allow you to do that you couldn't as part of VS Corp portfolio of brands?
Well, the single biggest thing was that we were part of a much bigger machine, and we were used as a bank. So the money that we made went to the bigger machine and went to the corporation versus being able to invest that money back into our brands and our people. And now we're able to invest that money back in. And I think that's the single biggest thing that's the differentiator. You think about this year, we've returned $168 million to our shareholders this year alone. We would have never gotten to do that before. But now we're taking these brands and we're pumping life into them and creating really good demand creation platforms, building really good product, building new and differentiated product too, like outdoor and t-shirt and things like that, t-shirts and things like that we couldn't do with the other company because we had to stay in a straight and narrow line, make as much money as possible so that it could be invested in other places.
Scott, your international wholesale growth is above that of the United States. How are you thinking in terms of going forward and a potential Trump presidency with tariffs involved, where and what countries do you see expanding in more?
Yeah, we're not speculating right now from an election standpoint. We're in a pretty good spot. Project Genius is going to help us really figure out our supply chain and what we want it to look like going forward. We're going to take costs out. We're actually a pretty good supply chain company right now already. This is just really bringing us to the next level. But we haven't really talked about what we think is going to happen. We haven't been speculating, but well, I guess we'll find out next week who it's going to be.
Maybe.
All right, Scott Baxter, really appreciate you joining us. Maybe it'll take longer than next week. CEO of Kantoor Brands, joining us from North Carolina. Coming up on the close, we're looking at Uber failing to deliver positive results for its core ride mobility unit as it faces softer U.S. ridership. We're going to recap this morning's report next in our top calls. This is The Close on Bloomberg. It's time now for our top calls, a look at some of the big movers on the back of analyst recommendations. And we're going to start with Super Microcomputer, a downgrade to hold from buy over at Argus Research, prompted by a massive sell-off on Wednesday. This after Ernst & Young said it would resign as the auditor. While Argus is positive on the company's long-term prospects, the analyst says he won't put the stock back on his buy list until it gets a new accounting firm and resolves its affairs before the DOJ can get involved. Shares down 13%. Bonnie?
Well, Scarlett, I'm taking a look at ARM Holdings. Bernstein cutting its rating on the chip design company to underperform from market perform. The analyst acknowledges that demand for ARM's AI-related chips is strong, but she's more concerned about sales for its non-AI-related chips. She also says she doesn't see much upside to ARM's valuation in the midst of what she's calling an overall glooming semiconductor environment beyond AI. ARM right now down 8.8%.
And Bonnie, let's end on Wingstop, the fast casual chain having a spectacular day. Get it? After BTIG raised its rating to buy from neutral, the analyst sees an attractive buying opportunity for long-term investors who are, quote, willing to look past the hyper-analyzing over what guidance implies for same-store sales. Shares marginally lower at $289. And those are some of our top calls. While Wingstop customers can, of course, use platforms like Uber Eats for delivery, the company saw growth in its food delivery segment and advertising business, but that was not enough to appease investors disappointed by weaker than expected ride bookings and a tepid forecast for the holiday quarter. So joining us with more on Uber is Ron Josey. He is co-head of tech and communications at Citi. Ron currently has a buy rating on the stock. And Ron, let's start with the U.S., which makes up a little less than 50% of gross bookings, but the majority of its profitability. The CEO said he's seen some slowdown in rides because higher insurance costs being passed on to some consumers. This sounds like it's going to be pretty sticky in terms of those higher costs being passed on.
Well, that's interesting. I mean, it's there are a lot of puts and takes this quarter. I think by and large, you can point to their 161 million monthly active platform customers that come to Uber every single month. You can point to the almost 6 times that people use it every month as well. And then obviously the 20% growth in mobility and 16% XFX growth in delivery. On the pricing side, it's, I think that's causing a little bit of concern or call it confusion around what that might mean for 4Q revenue or 4Q bookings. And so, guidance came in a little bit lighter than where consensus was. But if anyone can figure it out, I think that's going to be Uber. Mm-hmm. We talked about higher insurance rates, and because of Uber's approach with insurance and that they too are a captive insurance carrier, I actually think they'll be able to get costs under control here and pass along the savings, or call it less of an improvement or less of an increase in price over time. So I'm hopeful this is call it a 1 quarter thing on pricing from an insurance perspective, but by and large, the broader results from the quarter were pretty strong.
Yeah, and in terms of expanding its market opportunity, Uber's been expanding to suburban areas and also striking deals with new merchants like H Mart or Michaels and JD Sports so that customers can get deliveries sent to them as opposed to just food that they want to eat at home. What is the growth potential for this part of the business?
Well, I think it's, super early. I would say, as of now, Google's mobility business, which is ride sharing, and their Eats business, which is primarily food delivery, those are the biggest drivers of growth. But my goodness, when we think about the opportunity around grocery or just overall local commerce, that expands the available market by a significant amount. And so grocery alone, I think the last we heard was around a $7 billion run rate globally. We know that grocery is over $1 trillion business just in the US. And sooner or later, more than that 13 or call it low teens percentage of grocery that's online today is going to come online, maybe mirror overall e-commerce penetration. So there's, in our view, a massive amount of opportunity with these newer verticals. It's just going to take some time and a change in how consumer behavior, sort of how we go and we shop for our grocery, that takes some time too. And then there's, of course, some integrations from a tech perspective to make sure what you order is correct and things along those lines. So, it's going to take some time, but the bottom line is, Uber, as is other players in the space, like an Instacart or DoorDash, are off to a very good start here. And Uber is executing pretty well in their overall Eats business.
Ron, is it fair to say it hasn't exactly won the PR quarter this time around, though? I mean, we had that story about drivers, for example, being shut out of the app just randomly for hours potentially at a time. And also the idea that, you see that the car is supposed to come in 1 minute, but once you book it, it doesn't come maybe for 5, or the opposite.
Yeah, it's interesting. We heard in the quarter, Uber has 7.8 million earners globally. I think that was up, around 20% or so. So they certainly have the supply of drivers. These snafus or the ability, the reliability of the business and the service to get you that driver as fast, call it within 4 to 5 minutes. That's something the business is always working on. And frankly, I see the same headlines as you do. But by and large, I don't think you're growing your monthly users as fast as you are, or even your mobility bookings of 20% if users are going to another network. And I don't think that's happening. So I think it's just, maybe a quarterly snafu or once in a blue moon or so. But I think they know that reliability is core to that continued growth. And I actually think they're pretty well positioned to just continue to deliver and execute extremely well.
How can artificial intelligence, large language models and so on help a company like Uber? And at what point do we see those advantages in its bottom line?
Yeah, I think in a lot of different ways. I mean, it's very clear, I think, from a Meta, from a Google, and maybe even Amazon, certainly Amazon from an AWS perspective, to see what generative AI can do for you. I think for an Uber perspective, look, I think internally, customer service costs are one so there's a huge efficiency opportunity, is my point, whether it be customer service costs, where generative AI can be that agent with the consumer if there's a problem, the wait time as an example. I think management's talked about their developers becoming super developers as you're doing more with less, or doing more with more, maybe is a better way to say it. So, I think from a cost perspective, we're going to see that. We did see profitability grow this quarter.
Ron, thank you so much. Ron Josey over at Citi. This is Bloomberg.
It is about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I am Vonnie Quinn.
We have a big earnings day, by the way. I just want to get this in here because they haven't done so well in terms of the results that have come out. And now we've got Apple and Amazon on deck. And this could make or break, it feels like, the tone for the rest of tech.
You can be sure there are a lot of investors out there waiting for the next 40 minutes to pass by so that we can actually get to some of those earnings. But, if Microsoft and Meta were to be any kind of indicators of what's to come, it doesn't necessarily mean that that's what's going to impact trading tomorrow, right? Because there are so many cross currents right now.
Yeah, very good point. And it's, again, we will be breaking down all those earnings when we get them. It's been a busy week. We also have a read on the consumer.
We have a read on the consumer and obviously the non-farm payrolls report tomorrow morning. And also don't forget China in the background here, which is going to come to the foreground towards the end of next week when it starts talking about stimulus again.
Absolutely.
Meanwhile, third quarter results from Booking Holdings has investors saying Booking.yeah. Shares of the online travel booking service jumping today after the company beat estimates on gross bookings. Booking also boosted its financial outlook for the year as travel demand remains strong across markets. Joining us now for more is Glenn Fogle, who is CEO of Bookings Holdings. Glenn, thank you so much for joining. You spoke a lot about international travel demand. I'm curious as to US travel demand. Is it moderating slightly?
Well, thanks for having me. And we're very pleased with our positioning in the U.S. it's one of those things where we can't control demand, we can't control supply. What we control is trying to make sure we get more share. And we believe in the previous quarter, we believe that we increased our share of the business. And that's the thing we really are trying to focus on. I can't make people travel more or less. We have seen growth. Obviously, some of our supplier friends have reported different thoughts on how things went and how things are going to go in the near term. But from my point of view, I don't worry about the near term so much. We're trying to build for the long term.
Sure. What are you seeing, though, in the detailed data? Are consumers trading down on properties? Are they shortening stays?
No, we haven't seen that at all, and we haven't really seen that at all globally. In fact, we're very pleased with our growth rate in the US and other parts of the world, and it's been something that we have seen coming out of pandemic, a moderation after the initial incredible burst of people wanting to travel. Now we're in a more normalized situation, but we're still very pleased. Like, we came in with global numbers, 8% of our room nights up, year over year. That's a really good number. And it's something that we are looking forward to continue. We gave a projection, 6 to 8% was the guidance for the fourth quarter. I'm pleased with that.
Yeah. So in terms of outlook, how far in advance are people planning their trips away? Because as you say, things are starting to normalize, but it's been so long that I have a hard time remembering how we used to travel pre-pandemic.
Yeah, it's one of those things. People are always asking about this thing. It's called the booking window. And essentially, it's how far in advance are you going to book? And right now, we've been talking a little about expanding right now. And there was a time right after the pandemic came, when we were done with it, and inflation was very high. And we saw a real increase in that booking window. And I was wondering, hard to prove, were people trying to lock up the price today because they're concerned that was going to be much higher further down the road? That, of course, not nearly the problem at all nowadays. But again, not something I worry too much about. Sometimes it can be longer, sometimes it can be shorter. At the end of the day, it's all going to even out.
Speaking of locking in prices, I wonder to what extent your competition is airline loyalty programs or credit card points, because a lot of people will try to use those points up before they get devalued rather than going to sites like Priceline.com or Booking.com.
Yeah, it's an interesting point on that is where inflation could be in dollars or it could be in points, I suppose. Again, not a thing I worry too much about. And for us, we don't participate in those. We have our own loyalty program we call Genius, which we think is really superior in the sense that people are getting those discounts right away. And it's something that we believe is a different way to do it. We don't give out points, but we definitely see it. Our level 2 and 3 at Booking.com, Genius level 2 and 3, they produce a tremendous amount of our business. In fact, over 50% of the room nights come from those people.
You have an AI trip planner now, and I'm curious as to how that's impacting how people are booking. Are they booking different kinds of trips than they might normally, or are they, making decisions faster than they normally would?
Well, a couple things on that. First, I'm really happy we've had it out for quite a while now and continuing to iterate and improve it. And the idea, again, is to try and make it easier for people to get what they want. Now, in terms of the data, are people doing it faster or not? It's really small numbers compared to the overall size of our business. We talked last night a bit about it. I mean, we have what some may say a lot of people are looking at if you look at an absolute number. But as a share of our total number of customers, it's relatively low. And it's something that's still early. I believe that this, though, is going to be something that's really going to be transformational over time. And in the future, people will be using different types of generative AI trip planners to put together their entire trip. We're glad we think we're in the lead in this area.
Glenn, I have to ask you about the election. Are you planning out different scenarios in terms of corporate tax rates and so on, and what you should be preparing for depending on who wins?
Well, it's interesting. You say the elections. So immediately, I'll assume you mean the U.S. elections. We're a very global company. There are elections happening all over the world, different times and stuff. We don't particularly choose how we're going to try and change our business based on one particular political event or not. We're always looking at all the elements that could influence our business, always to have a good planning. I mean, preparation is a great way in terms of anything that can happen. But in terms of actually coming out and saying what we're going to do differently or et cetera, we'll wait until we actually see a closer in of what law changes may or may not happen.
You know, Vani started by asking about the strength in Europe and Asia and kind of asking you to contrast that with what you're seeing in North America. I'd like you to talk a little bit more about what you are seeing in Europe and Asia, given that China has been trying to stimulate its economy, but so far consumers still seem unconvinced that now is the time to spend. And of course, that resonates throughout the rest of the region as well. In addition, you know, we're seeing Europe slow down. They're not in recession. They're not heading into recession necessarily, but inflation has definitely taken a bite out of the consumer.
You know, it's interesting because we talked last night about the different regions and how we did in the third quarter. And we were very pleased with Asia was our leader with a low double-digit growth rate, and Europe was a high single-digit growth rate. So Europe's still doing okay, even though we do see some of the GDP numbers a little lower than you would want them to be. That being said, we believe, again, different parts of the world are going to perform at different times. It's great to be so global that one area that does slower, not going to affect so much if other areas are able to pick up the slack. In terms of China, yeah, there certainly have been some issues there. And in terms of international outbound business, which is the area where we're more, where we do more business there, it's still not up to where it was in terms of for the industry. I'm not talking about specifically, I'm saying for the industry, right. In terms of outbound Chinese business, not quite where it was pre-pandemic yet, but it is still coming back. And obviously the government there is working to try and figure out how they're going to stimulate the demand there for their total economy. We'll see what happens. But again, one small part of our overall business.
All right, good stuff. Glenn, really appreciate your joining us today. Glenn Fogle is CEO of Booking Holdings. And we're going to stay on the travel theme here because I don't know if you saw shares of Norwegian Cruise, Vani, up as much as 12%, boosting its outlook once again, demand remaining high. People are booking their vacations. They want to get back, and they want to get back to some of their pre-pandemic norms.
They like those ships. A total in the quarter, Scarlett, this is not the year, in the quarter, more than 800,000 people took a cruise. Wouldn't it be nice to have the time to just get on a large boat and be entertained and have your...
Are you hinting at anything?
Well, you know, I do live close to the place where they take off. What's that called? The port? Thank you. Yes, the ports. Yes.
Well, you know, you can just drive by on the West Side Highway and admire and, you know, look at all the people who are doing that. But, you know, what was interesting as well is that for Norwegian Cruise, it's really the main money makers are shore excursions. It's, you know, getting the people to a port and having them go off and do their thing and come back, spend a lot of money before they take their next leg.
And it's interesting how people have totally forgotten all the problems of the pandemic and all the problems that sort of plagued the cruise liners before that, because it's not just Norwegian. The other cruise liners also had a good quarter.
Absolutely. And we'll bring you those results as they report them. But for now, it looks like people are willing to spend on those cruise lines. In the meantime, we are keeping an eye on other shares moving and trading today, including Estee Lauder. They are plunging after the cosmetics company cut its dividend and pulled its full year guidance. It is our stock of the hour, and it's up next. This is The Close on Bloomberg. Welcome back. Estee Lauder shares down 22% after the cosmetics company pulled its full year guidance, citing uncertainty over its new CEO and weakening demand in China. Here now to discuss is Bloomberg's Abigail Doolittle. And you and I were just discussing how this kind of looks like a kitchen sink quarter.
Yeah. Oh, it definitely looks like a kitchen sink quarter. And a lot of times you will have investors sell the stock off like this. Other times it will rally. But the fact that it's selling off, having its worst day ever, tells you that investors don't have a lot of confidence in what's next. And one reason they don't is they cut guidance back in August. So now they're just pulling guidance altogether, saying they have no idea what's ahead. They're talking about weakness in China, but it's also the U.S. There's so much competition out there right now. So they're creating this reset, essentially. The other thing they did is they cut their dividend by 47%. That could be a good thing because it means that they want those funds to fuel new growth. But I think just the level of uncertainty, and in addition, in the quarter that they just reported, the current quarter, they were saying that, or this quarter, that sales could fall 8% versus a year ago. One analyst calling that frightful. So it's just, there's no good news here.
So the new CEO, Stéphane de la Faverie, comes from inside the company. He was head of the Le Labo unit, Kilian Paris, The Ordinary, some of the really top brands at L'Oreal. What does he do about stimulating demand in China? Is there anything he can do?
That's to be seen because it's the China demand in terms of the overall economy. And we're hearing a lot of stories about how it's weak there and the need for the stimulus. One of my sources, Scott Kelly, who's a real estate person, he said that it's so much worse there than people really believe here when you go street on the feet, which he has done. So I think that the demand is weak there. And in addition, Scarlett, I think a few weeks ago, you and I were talking about this maybe with Romaine, is the Asia travel demand. Within airports, because Asia travels down, that's another reason that those products. So I think that where his job is probably to really figure out how to position all of these brands, really important here in the U.S. I don't know about the two of you, but I often go to Sephora, and in Sephora, there's a million different brands. A lot of them are clean brands. I mean, there's just so much competition right now. When, 20 years ago, Estee Lauder, for me, as somebody who loves skincare, it was sort of one of the premier brands. Now it's just one of many.
Yeah, it also feels like legacy brands, right? It doesn't have that freshness that some of the other brands that you just mentioned.
And maybe that would be his work to do.
Right, possibly. I guess it's worth noting here that L'Oreal, which is a rival, also posted disappointing sales in China. So certainly Estee Lauder is not alone in trying to figure out this China issue.
Or in makeup and beauty products in a way. I mean, maybe this is one more tell. We've been trying to figure out the state of the consumer for a while here. Maybe some consumers are willing to give up some of their beauty products if it's not, the must-have, need-to-have.
Well, the stock's taking an absolute beating today, down almost 22% right now. Abigail, thank you so much. That is Bloomberg's Abigail Doolittle. Coming up, we're going to be counting you down to the close with Emily Leveille, who's portfolio manager at Thornburg Investment Management, on a day when we are seeing stocks fall out of bed. Perhaps it's profit-taking, perhaps it's just Halloween. This is Bloomberg.
We thought for quite some time that the market got ahead of where the Fed was ultimately going to end up. As such, we actually reduced duration leading into the last Fed meeting. And from our perspective, listen, the economy is really, really strong. I think you saw that today with the jobless claims data, yesterday with the ADP data.
That was Mike Contopoulos. He is Director of Fixed Income and Portfolio Manager at Bernstein Advisors, kicking us off to the show. And again, we come back to that theme that the economy has proven stronger than anyone had anticipated. The Citi Economic Surprise Index just goes up, 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 up.
Exactly. And the data today continuing to perform fine, right? The employment cost index down just a little bit, which is probably something the Fed is quite happy to see. Initial jobless claims were not terrible. And we had, inflation data that shows the Fed is continuing to move towards its goal, although that shelter part is still sticky, Scarlett.
Yeah, and of course, we're waiting for more earnings to come through to really give us a better read on how companies are getting us through this period.
Speaking of companies, we were talking about Estee Lauder a moment ago. There is a company that is literally outperforming Estee Lauder to the downside. So the worst performer right now in the S&P 500 is Huntington Ingalls. You'll know it because it was the contractor for the USS Gerald R. Ford warship, the $13 billion ship that was delivered back in 2018. 8 months later, Scarlett, it was returned to port because of problems. Navy documents said the defective gear was as a result of machining errors by a GE unit. Okay, you're following me?
I am.
So now they got into this thing with GE. Finally, there's been a settlement. There was no lawsuit, but there was a settlement between Huntington Ingalls and GE. Details not publicly disclosed, according to an HII spokesman, but you can see the stock there down 26%. So that settlement obviously didn't go Huntington's way. Then I wanted to point to Amazon and Intel, because you're obviously going to stick with us while we break earnings a little later on. But as you can see, the stocks are both down more than 3%. That is in keeping with the theme of the day. Not so for Reddit, though. It had a 42% increase yesterday and up another 2.6% today. Scarlett, you'll remember Reddit was priced in March at $34 a share. It opened at $48 a share, and now we're at $119.
Look at it now. It's delivering on all the AI promise that it had talked about.
And subscribers, yeah.
And subscribers. All right. Well, let's combine the two of what we've been talking about, the macro with the economic, with the anecdotal from the companies. So for more analysis, we want to welcome Emily Leveille. She is portfolio manager at Thornburg Investment Management. And Emily, we talked about the economy doing better than anticipated, surprising economists, surprising investors, clearly. I know your stance on this is that you still think a slowdown will come. It's just kind of taking a little bit longer than you had anticipated. Why do you think it's still going to come, and where do you think it's going to show up first in terms of corporate earnings?
Hi, good afternoon. Yeah, I've been surprised positively as well since the summer on the consumer. We still think that it makes sense to be cautious when looking at consumer names. I mean, I just think if you take a step back and you look at 500 basis points of rate increase over the last 2.5 years, it's really hard to see that not impacting the consumer at some point. Now, obviously, jobs have continued to be really strong, and I think that's really what's holding everything up. But you're still seeing a bifurcation in, how consumer companies and how consumers are responding. Inflation is really biting people. So we prefer to stay cautious, focus on the names, on the companies that can really control their own destiny, and then focus on the super high-end companies that aren't going to be as affected by some of these issues around inflation.
Okay, so when you talk about companies that can control their own destiny, if you want to be invested in the AI play, which names are those? Because look at how Meta is trading today. Look at how Microsoft is trading today. They control their own destinies, but they can control the reaction they're getting today.
So my takeaway from the earnings that we've seen so far from the hyperscalers is that the arms race continues, and you want to own the arms dealers still. That is TSMC, ASML, NVIDIA. I mean, TSMC is really the gating factor on how fast AI can expand within the cloud service providers, because they are the ones that are allocating the majority of the capacity for chips. So, we really want to focus on those picks and shovels. We still think the chips manufacturers and the semiconductor supply chain is the way to go. The cloud service providers are also going to be, some of the first beneficiaries of that revenue. I think investors are giving them a little bit of hard time. It's the specter of ROI coming back, if you will. But look, these are long-term thinkers and investors. They don't want to miss this platform shift that's happening. And I think they're going to continue to invest and spend as much as they can into the next year at least on building out this data center capacity.
Most of these stocks have seen massive run-ups, though, Emily. So even if you don't think they're overvalued or too overvalued relative to, say, the 2000-era type valuations that we saw, wouldn't it be a little wise to pull some money out and put it somewhere else?
Absolutely. I mean, I think we always want to think about diversifying our sources of growth. But, when we look at how these companies have performed year to date, NVIDIA, AMD, TSMC, the majority of the outperformance has actually come from earnings acceleration. So, when we look at valuations, they don't seem totally out of line. That's very different from what you saw in sort of, the run up to the bubble bursting in the early 2000s. So, we do deep fundamental research here. And as long as we feel comfortable with the earnings growth and earnings power of the companies, then we're okay holding through these periods of volatility.
Emily, what did you make of the Goldman Sachs note the other day that suggested that we're looking at measly returns over the next 10 years in the order of 3%? By the way, many people disagree with this vehemently, including Ed Yardeni, among others.
Well, we're international investors. We primarily focused on investing outside of the U.S. in high-quality companies that are exposed to areas of structural growth. It's tough with the S&P at 26 times earnings to continue to see the type of compounding growth that we've seen in the United States over the last decade and a half. So I don't necessarily disagree. We really focus on finding the companies that are just as high quality with just as interesting earnings potential outside of the U.S. that are trading at much lower multiples. I mean, just to give you an example, China, even after the big run that China has had in the last month, the Hong Kong index is still trading below 10 times earnings. So if you get some earnings acceleration there, you're going to see a really powerful combination of earnings growth and re-rating, and that's going to lead to some really impressive returns that I think is going to be hard for the S&P to beat.
Very quickly here, Emily, you say that international markets are not yet priced for any kind of Donald Trump victory. What kind of asymmetric opportunities do you think that creates?
Yeah, we see it a little bit. I mean, China, you see it a little bit in some emerging markets as well. I think Europe, there's a little bit of risk potentially. If you get a Trump win, you're going to see more tariffs. You're going to see more inflation. I think Europe is not totally priced for that. We're really investing in companies. We want to invest in companies for our clients that are going to be able to perform and grow their earnings regardless of who's president in the United States. But we absolutely take that into consideration and make sure that we've got in our portfolio, companies that are well positioned for either scenario.
All right, good stuff. Emily, really appreciate your joining us today. Emily Leveille is portfolio manager over at Thornburg Investment Management. And she's talking about deep fundamental analysis. That's what we're going to be getting into in the next half hour as you have big companies like Intel, like Amazon, and of course, Apple reporting.
Yeah, exactly, on Halloween, but that doesn't mean anything.
Okay, we're moving closer to the closing bell. Full market coverage begins right here on Bloomberg Television and Bloomberg Radio. Keep it here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. I'm Scarlett Fu here with Vonnie Quinn, and here to help take you through the closing bell, we've got a global simulcast. We're joined now by Tim Stenvick and Emily Garfeo in for Carol Masser. Welcome to our audience across Bloomberg Television, radio, and YouTube. And Tim and Emily, we look at what's going on in the markets. It very much feels like a risk-off day with indexes just coming off their worst levels of the session and bonds moving higher.
Yeah, it's all about mega cap tech today, just driving down the major indices. I mean, we got shares of Alphabet lower, we got shares of Microsoft lower, we got shares of Meta Platforms lower. We're going to hear from Apple after the bell, and we're going to hear from Amazon. But I'm looking at the Bloomberg Magnificent 7 Total Return Index. It is down as we speak by 3.3%.
And, this was really the first day in the whole month that we finally saw some action for the S&P 500. After 29 days of moves under 1%, we're finally seeing some big moves in the major indexes.
Literally what I was thinking, Emily, it's incredible that it took this long, but 1.8%. And this is only the second negative month of the year, the other month being April, Scarlett.
Yeah, it's pretty incredible. But a lot of this maybe just be positioning ahead of the election. I mean, there's pre-election tactical moves, and then there's let's wait and hold our breath, hurry up and wait until we get the actual outcome. And then it's, the conventional wisdom right now is that will unleash everyone's animal spirits, and perhaps people go back in feeling a little more confident that there's some certainty rather than an actual position on what happens.
Regardless of who wins, though?
Regardless of who wins. That's what I keep hearing.
So I don't understand why everybody's waiting. Because one of them is going to win.
Because you still never know. All right, here we go. We've got the closing bells ringing at the New York Stock Exchange and at the NASDAQ, and you are looking at some steep losses here, certainly for equities. We have the S&P 500 losing 1.9%, a loss of 108 points. The Dow Industrials losing 380 points. The NASDAQ down by 2.8%. Disappointing reception to Meta and to Microsoft's results as we await Intel and Amazon. And the Russell 2000 also a laggard here, down by 1.6%.
We did see more stocks move lower than higher in the S&P 500. They're still getting settled, but as of now, 133 stocks in the S&P 500, 134 moved higher, 368 moving lower today.
Yeah, let me point out, if you look into the various sectors, you'll see that they are pretty much all red, led by information technology, as you've been pointing out, Scarlett, Tim, and Emily. Obviously, the Mag 7 down and the stocks down big as well. We are seeing some green for energy, but that's just in the last few minutes on an Axios report that Iran may be planning an attack on Israel via its proxies.
Okay, while we wait earnings, I'm going to...
We just got everything. They all came out at once. All right.
This happened to me yesterday, too.
I know. They knew you were talking. Let's start with Intel. Actually, you know what? Let's start with... let's start with Intel. Let's see. Third quarter revenue of $13.28 billion. That does exceed the average analyst estimate of $13.02 billion. But in terms of the outlook, $13.3 billion to $14.3 billion. Analysts were looking for somewhere in the neighborhood of $13.63 billion. This is a stock that has just taken a beating the last couple of quarters, really being disappointed when it comes to its outlook in terms of what it's saying. It had to pull its guidance. This is a company that needs to get back on course with catching up to NVIDIA and really figuring out what its strategy is going forward.
Okay, well, you've been looking at Intel. I'm looking at Amazon. Shares at Amazon are higher by about 2.5%. They're kind of bouncing around right now. The headline, though, is fourth quarter net sales coming in at 181.5 billion to 188.5 billion. The estimate was for 186, so a little on the light side when it comes to the guidance. Fourth quarter operating income coming in also a little light within the range, 16 billion to 20 billion. The estimate was for 17.49 billion dollars. Third quarter net sales, though, did beat estimates. Third quarter AWS net sales, they came in just shy of estimates at $27.45 billion. Estimates for $27.49 billion. Third quarter operating margin coming in above estimates, though, 11%. Estimates were for 9.34%. Third quarter operating income coming in higher than expected at $17.4 billion. Estimates were for $14.75 billion. Amazon shares now in the after hours finding a direction. That one is higher up by more than 5%.
Yeah, surprising to finally see some positive movement in these big tech stocks. I'm looking at one that is not a technology stock, Avis Budget, ticker CAR, because they missed estimates estimates, at least on the third quarter revenue, America's revenue coming in at $2.64 billion versus estimates of $2.72. Adjusted EBITDA down 45% year over year. And the stock unchanged right now, but was already down 50%. That's 50% year to date. That adjusted EBITDA also missing estimates at $503 million versus estimates of $5.28.9. And revenue, $3.48 billion, also missing estimates.
I want to bring us back to Intel once again, Emily, and just to recap, the revenue range was quite massive, actually, $14.3 to $13.3 billion, but the estimate was at the very low end of that range, so that pleases investors. Then when you come to the operating margin, it was minus 17.8% versus positive 13.6%, so not a great figure there. And then also earnings per share, well, that was a loss, 46 cents of a loss per share versus the estimate for 41 cents year over year. That said, you are seeing a lot of positivity on the stock in the after hours trade, up more than 10%. Of course, Intel, it could be a target for some companies too.
Yeah, there were reports, for instance, that Qualcomm was looking to make a bid, but it wouldn't do so until after the elections, and there was some certainty over who's in the White House and who is regulating the different agencies, who's leading the regulation agencies. In terms of commentary from the CEO, Pat Gelsinger is speaking with reporters right now, and he's talking about how Intel has taken some steps to reduce inventory in PC processors, and that, to your point, Vani, he intends to keep the company together. He says that a distinct but better together is the strategy right now. I'm not sure what that means in terms of, that sounds like corporate speak, but I'm sure there's more detail behind that. But the idea being that Intel does not want to be acquired by a bigger company, and it does want to go it alone and move forward with its plan to kind of get back on track and perhaps outsource some of its chip making capabilities.
Shares of Intel higher by 10%, solidly in the green right now. I do want to remind everyone that there's a special edition of Bloomberg Technology tonight at 6 p.m. Wall Street time. Ed's going to be speaking with Intel CEO Pat Gelsinger right here on Bloomberg TV, Bloomberg Radio, and on YouTube. I do want to go back to what Amazon is doing. It's solidly in the green as well after hours, up 5.3%. The company reported net sales for the third quarter that beat the average analyst estimates, sees net sales for the fourth quarter coming in at $181.5 billion to $188.5 billion. The estimate was for $186.36 billion. Also looking at the press release, Andy Jassy saying that he's excited about what we have in store for customers for the holiday season, saying that he kicked off the holiday season with the biggest ever Prime deal days, and the launch of the new Kindle lineup significantly outperforming expectations. He talks about the NFL Black Friday game, Election Day coverage with Brian Williams on Prime Video, and 100 new cloud infrastructure and AI capabilities that they're going to share at AWS reInvent the week after Thanksgiving.
And of course, Tim, we think about Amazon, I'd at least do, as an e-commerce company, but let's not forget their physical stores are also a large part of the business. Net sales for physical stores up 5.4% year over year, $5.23 billion, beating estimates. And then I'm also looking at their AWS net sales. That's their cloud business, because that slightly missed estimates at $27.45 billion. Still up about 20% year over year, but just slightly missing estimates.
Yeah, I mean, I think it's the forecast that's impacting how these stocks are trading after hours, but we will have to see how they trade tomorrow, because if you remember, we had all sorts of volatility for Microsoft and Meta yesterday, and then we had shocking days for both of those stocks today in the wake of the sell-off on Wall Street. So will we see an even more brutal sell-off tomorrow, which obviously we'll have passed Halloween, but we'll be on All Souls Day, so maybe it's just as bad, and maybe there'll be more profit-taking before the uncertainties of next week. We'll have to see. But once again, investors liking these forecasts, both for Amazon and Intel.
And one thing that they do like in particular is the operating margin, because that really reflects whether the spending on all that AI build out is hurting the profitability of the company. In the third quarter, operating margin was 11%, better than what analysts had been anticipating, which was 9.3%. And this is even as Amazon Web Services sales growth was pretty much in line. And these days, Bonnie, to your point, if you don't beat by a large amount, that's reason for investors to take it out on you.
Yeah, and that's exactly what happened with Meta Platforms and with Microsoft. The question there was about CapEx versus how much money they're going to be spending on CapEx next year when they invest in these in doing AI and actually seeing a return on that investment from AI. And we saw what happened today. So we'll have to wait and see what we hear on the calls. I want to remind everyone, 4:30 is when we expect Apple results to cross. We're having special coverage right here on Bloomberg Radio. I know you guys are continuing to follow all the results on Bloomberg TV as well. That is going to do it for our cross-platform coverage today, this earnings bonanza. Catch us same time, same place tomorrow right here on Bloomberg TV and Radio.
All right, we're going to continue our coverage of these earnings that just broke at the top of the hour, Amazon and Intel in particular. So here now to help us break those numbers down is Bloomberg Technology co-host Ed Ludlow. And Ed, a very different reception today to these two sets of earnings compared with what we saw from Meta and Microsoft.
Yeah, where would you like to start? I think Amazon's kind of more straightforward in the sense that you are right. You go straight to the outlook for the final 3 months of this year. And whether you take the operating income figure or the revenue figure at the midpoint of the range they gave, it's at least in line or ahead of analysts' expectations. The calculus for Amazon is very straightforward as it was with Alphabet and Microsoft. We know about all of the capital expenditures which are going into data center capacity. You're going to have to wait until the call with analysts, noting this quarter for the first time, Amazon does not have a call with the press before the analyst call, to hear about the numbers from actual AI perspective for revenue generation. Just simple stuff. Tell us about the money you're making from selling AI services to enterprise customers. That's kind of what it comes down to.
And just on Intel, briefly first, Ed, I mean, this is really a pitiful kind of a quarter,
yes.
It strikes me. And yet we are seeing the stock higher after market, but who knows why, right? Maybe investors are thinking that something else is going to happen with this company. But for Pat Gelsinger to have to come out and say we have 2 more external customers, that's a difficult quarter.
I started with Amazon because it was easier. Intel, there's a lot more to clear up. So in the quarter just gone, note that there were significant impairment charges that hit the bottom line, which accounts for the adjusted loss per share being way more significant than the street had anticipated because they didn't know the impairment charges would come in that quarter. The headcount reduction, the cancellation of projects. The story of Intel in the quarter gone was actually the data center business did better than expected, and the PC business did worse than expected, but they're clearing through a backlog. If you look at the forecast again with Intel for the final 3 months of this year, it looks like things are okay. And you guys mentioned the headlines of Pat Gelsinger's commentary. That was an interview that Bloomberg's Ian King did with him very quickly. And the explanation, Scarlett, to what the Better Together quote is referencing is that he wants to run this business with the products unit and a manufacturing unit, contract manufacturing for semis. There'll still be one company, but 2 distinct divisions. And he seems committed to that amid all of the speculation about other peers in their field interested in buying some or all of Intel.
Right. And what is the latest on that? I mean, our understanding is based on the reporting that Qualcomm was said to be interested, but it's not looking to move on anything anytime soon until after the election and until after there's clarity on who's in the White House and what regulation looks like.
Scarlett, I don't know the answer on what the latest is. Your summary is correct that the reports were that ARM was interested in a part of Intel, and that Qualcomm was interested in a part or all of Intel, noting it has a products division and a manufacturing division, but would wait until after the election. Fortunately for the street and the market and for us, there's an analyst call coming, and then after that analyst call, Pat Gelsinger will join me on that Bloomberg Technology special, and I will ask him explicitly for an update on that situation.
Yeah, we can't wait for that, Ed. Difficult news as well for a lot of employees. Intel saying that it's going to reduce headcount by 16,500 employees. It has just more than 125,000 right now.
Yeah, it's a deeper cut, but I think the point that Gelsinger is trying to get across, as is reflected in the impairment charges and the numbers they reported for the third quarter, they feel they've done the difficult and painful work now. They have fallen behind in certain product areas of data center and PC, but they were too bloated, so they cut back on projects. And the point they're trying to get across to us, and the market appears to believe, with the stock now up 12.8% in after hours, is that from this point they've done the difficult bit and they can start to focus on growing again. That's just the market's reaction.
Yes, it is. All right, Ed, thank you. And there will be more of a reaction after your interview a little later on. That is Bloomberg Technology co-host Ed Ludlow. You can see Ed again tonight for a special edition of Bloomberg Technology interviewing Intel CEO Pat Gelsinger. That's at 6 p.m. Eastern and is going to be a must-watch interview. Sticking with those tech results now, let's bring in Daniel Morgan, Senior Trust Portfolio Manager at Synovus Trust. So let's get straight into it, Dan, with Amazon. First off, jumping more than 7% in the after-hours trade. Your reaction to these numbers?
Well, I think overall the numbers look pretty good. Let's kind of start off with Amazon. Obviously, the guidance they gave for the upcoming fourth quarter was at least, within the semblance of the estimate in terms of the ranges they gave. I think the big number that stands out for me is the AWS number. You mentioned that they came up a little bit shy. I think the street was at $27.5 billion. I think you said $27.45 billion. That would represent approximately 18 to 19% growth rate. And, if we go back and we look at some of the other companies that are in that same space, for example, Microsoft, Azure, which is their equivalent competitor to AWS, they were up 35%. And if we look at GCP, which is Alphabet, they were up about 35% also. So kind of interesting to kind of compare these growth rates between, let's say, Microsoft Azure at 35% and that of AWS, which was a little bit under what the street was looking for.
Yeah, absolutely. And also fourth quarter operating income, it's quite the range that Amazon is giving, somewhere between $16 billion and $20 billion. Does that indicate that Amazon has no clarity and that maybe even it's the election that Amazon is hedging for?
Amazon has a lot of moving parts. Their two core businesses that really drive their growth is the AWS, which we just talked about, and then, of course, their online business. They have a burgeoning advertising business that is doing very well. It's growing 19-20%. Their retail core business, which is basically selling things online, is growing at about 9%. So, there might be some, unknowns in regards to going into this upcoming fourth quarter. We know they're getting a lot of competition from Walmart in that same space. I think there's just some moving parts. You're not quite sure how strong the Christmas season is going to be. Just a lot of moving things out there. But those are the two things that really drive Amazon in terms of growth.
And of course, not just Amazon, but the other big tech names, whether it's Microsoft, whether it's Meta, is the spend on AI and the build out of AI capabilities. Dan, is there a baseline for what's acceptable of how much they spend on AI? How do you judge what's reasonable? Is it something like CapEx growth cannot outstrip revenue growth? Is it something like CapEx has to be covered by free cash flow? I'm just wondering if there's like a formula or it's more, we'll know it when we see it.
Hey, you bring up a good point, Scarlett. Amazon for this, we're going to close out this year, 24. They're expected to spend about $69 billion on CapEx. So it's a big number.
Yeah.
So you're right. Do you say, okay, well, how much money do you have on your balance sheet, right? How much are you holding in cash and investments? What is your free cash flow? Are you going to have to issue debt to meet this CapEx target that you have? These are the kind of questions that kind of go through your mind. But you're right. If you were to put together all the hyperscalers, the ones that you just mentioned, Microsoft, Meta, Amazon, and so forth, and Alphabet, they're expected to spend about $185 billion this year alone, just in CapEx on it. And most of that's going to go to AI. And then you're kind of scratching your head, well, what's your return on investment? Are you ever going to even get that back?
Mm-hmm. Absolutely. And, the consensus is that we're in the early stages of this AI build out. But if the economy does slow down further from here, how comfortable are you or other investors going to be with the continued rate of CapEx? Will it become more important because it's an opportunity to wring out more growth when, the weaker players can't spend?
Yeah, I would expect the CapEx numbers to come down. I follow a lot of the chip companies, especially some of the equipment makers, and also some of the fab companies like TSMC. And, they're very quick to cut CapEx when they start to see their revenues and earnings go down. Micron Technology is the same way. They'll pull their CapEx down when DRAM prices fall. So, those are just estimates. Those are just what the expectations are. But I would expect those CapEx numbers to come down if we, in fact, did see a massive decline in terms of the economy. I think consensus estimate for GDP next year is about 1.8%. So still growing, but not at the same pace we're growing right now.
So Intel then, Dan, if we can move to Intel, it's surging obviously in after hours trading. It did give an inline forecast. It is continuing with its rebuilding plan, and Pat Gelsinger is trying to put a brave face on all of this, even though there's going to be 16,500 layoffs. What did you make of the quarter for Intel?
Well, to me, it was really kind of mixed. I mean, as your previous guest mentioned, you look at data center, you look at client computing, there really wasn't a huge amount of growth there. Their foundry business, one of the questions I always have coming into that, is it going to be profitable? Was it profitable in this quarter? When is it going to become profitable? We were talking earlier about CapEx. I mean, they're expected to spend roughly about $36 billion over the next 6 quarters, and they only have about $29 billion in cash. So are they going to have to issue debt to be able to meet this CapEx target and kind of build out these foundries? So, the way I view Intel right now is it's just a company that's in transition. They really fell behind in regards to the AI competition with companies like NVIDIA and AMD and Marvel and Broadcom. They've been really, hurting in terms of their client computing group versus the likes of AMD. A lot of their key markets they've been struggling in, and then on top of that, they're trying to do this big foundry layout. I know you were talking earlier about maybe Qualcomm coming in and giving them a hand and buying them out and giving them some capital, but they're in a tough spot. That's all I can say.
Yeah, that is a long laundry list for Pat Gelsinger to get through. Dan, really appreciate your joining us and giving us your thoughts on these companies. Daniel Morgan is Senior Portfolio Manager at Synovus Trust. Now, we do want to bring you some other earnings. U.S. Steel right now moving up in the after-hours trade by about 2%, 3%, and this is after it reported third quarter EPS and revenue beat analyst estimates, whether you're looking at adjusted net, adjusted EPS, or net sales. Steel shipments for the quarter also coming in higher than anticipated, 3.52 million tons versus the anticipated 3.543 million. And the outlook for fourth quarter, adjusted EBITDA of 225 million to 275 million. The consensus estimate is 268 million. So that is a little higher than the midpoint of that range U.S. Steel did offer. The big question, Bonnie, here when it comes to U.S. Steel is what happens next? Does it go forward with this planned sale to Nippon Steel?
Well, and if it can't, then what does it do? Because it's a complete minnow when it comes to a comparison between the two. Nippon is a huge player in this space, but we know that Kamala Harris has said that, the Democrats are not really in favor of this deal, and we know that Donald Trump is protectionist and not favor of this deal. Interestingly enough, some of the rank and file workers do want it to go ahead. They are opposing their union chief.
Yeah, well, we'll wait to see if they say anything on this. I don't know that they can say that much because a lot of it is out of their hands. In the meantime, we have a lot more coming up on the close. Amazon's Alexa's new AI brain is stuck in the lab. We're going to take a look at what happened to Alexa and its role in the AI revolution here. That is this week's big take, and we're taking a closer look at it next. This is The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Worth getting out of bed this morning.
The employment outlook, it's been bullish. People are good.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
How dependable is this data?
People want to know the outcome of the U.S. presidential election before they start maybe moving jobs. And guess what? The Fed has to make a big decision based on this data.
The October Jobs Report, Friday on Bloomberg.
All right, we are, of course, tracking shares of Amazon, and they are moving in the after-hours trade right now to the upside following the latest quarterly results. We want to bring in now, of course, the subject of today's big take, because Amazon faces technical challenges to debut an upgraded AI-infused Alexa, which is, of course, its platform that has done very well, but maybe not as well as you thought, given that it should be a bigger part of its AI plans. Bloomberg's Spencer Soper has been writing about this and joins us now. So, Spencer, it would make sense that Alexa would be a big part of whatever Amazon does with AI, but so far that hasn't been the case.
Yeah, they've been a little bit stuck, and Alexa in general has just been kind of stuck. If you remember going back, say, 10 years or so ago, it was kind of a phenom, and everyone enjoyed it. There was some novelty, and people were using it. But that use case really got stuck as being like a kitchen timer, or maybe just playing some music, but using voice activation. It never really grew beyond that. It never got to be this kind of conversational tool that Amazon wanted it to be. And so all of the Gen AI advancements kind of got Amazon excited that they could refresh an Alexa and maybe bring it into make it more usable and conversational. But it hasn't really happened. And some of their experiments with sports data and that sort of thing, they're seeing the limits of the system they have, and they're having to push back dates that they can unveil a new and refreshed version of the Alexa platform.
Well, I was just going to say, it's not like they can abandon it at this point either, Spencer, because so many people are on the platform and they obviously want to keep them, right? So what do? Do they just sort of wait and hope that more research is done and that they can get some more services out there?
Yeah, and actually what you just said is precisely the problem, that because they have so many devices out there, people want them to work the way that they're accustomed to having them work. It can turn on your light. It can set your kitchen timer. You can ask it how to make chicken marsala or what the weather's going to be. As they start tinkering with that and trying to add new capabilities, they don't want to alienate the users they have by kind of gunking up the existing use cases. So that's a problem they have that some of these newer Gen AI tools don't have. So yes, they're having to kind of navigate this area of expanding the capabilities of Alexa without messing up the capabilities it already has.
So it basically needs to build out a large language model separately, like on parallel tracks, as what it's doing with Alexa. Has Alexa reached the limits of its capability then?
I don't know. I mean, they've always wanted Alexa to have more capabilities and potentially have more capabilities. It's just nobody wanted to use them. You know what I mean? Like they wanted people to use it to shop and add things to carts, and none of that really took off. So a lot of ways it was like a solution looking for a problem. So whether these things develop into actual solutions to actual problems remains to be seen.
All right, Spencer, really appreciate your joining us. Spencer Soper, a reporter there covering Amazon, of course, and he is the author of today's Big Take. In the meantime, we want to take you to today's top three, where we name drop some of the people driving the day's talked about stories within the tech space. And first up is Peter Stern. Vani, he is a Ford executive. He is set to take over as Peloton CEO. And boy, news of his appointment has sent Peloton shares soaring.
You know what's fascinating about him is that not just is he a Ford previous alum, but he's also ex-Apple. And I think this is one of the things that are giving Peloton investors so much hope, because, at Apple and even at Ford, he was in charge of things like consumer experience. And that's what you need at Peloton. You're going to need people to be engaged in those apps and, using more of the services. I am looking at the Kim family, James Kim, the family of the tech titan Amcor, of course, in talks to buy a minority stake in the Eagles. I mean, this is the Philadelphia Eagles football team. Yes, I didn't want to say the city, but there you go. It is the Philadelphia Eagles. But that said, it's still a fantastic football team. And it's just amazing. If you're able to get your hands on a piece of these football teams, you are absolute royalty, not just in the United States, obviously, but in the world. It is the royalty of the United States, these owners. Yeah, and apparently it's Susan, his daughter, who's kind of leading the effort here. And this is according to our reporting, people familiar with the matter. And of course, this is still pending. We don't have any kind of confirmation on the transaction, but it's set to value the Eagles at least $8 billion, which, goes right along with some of those numbers that we've been hearing from these NFL teams. It sounds fairly richly valued to me, but if you've got the money, why not, right? And there's a small handful of people who have the money to do so. All right, third on the docket is Sam Altman. Maybe he'll be buying a football team soon, too. His OpenAI is adding a new set of search features to ChatGPT, escalating its challenge to Google. He is the burden on, I guess, is on him to kind of stay one step ahead of everyone else, since they have the early mover advantage here. I do find it fascinating that he's constantly in the news headlines. That this earned media that we talk about when it comes to politics also applies to Sam Altman. He's always traveling around the world. He's constantly advertising new things. There are constantly things changing, within the company, and the structure of the company changing and so on. And sometimes not by his choice, right? Sometimes it's because of the wrong reasons. Correct, but like good politicians, he always manages to spin it to his favor, it seems to me anyway. All right, well, let's transition to the next big headline that's
going to come and cross our headlines any moment now, and that is Apple's results. Apple reporting its fiscal fourth quarter numbers, and really the issue here with Apple, Vani, is that it's kind of been late to the party, the AI party, and it's playing a lot of catch up. But maybe that doesn't matter so much, because when Apple decides to go in on something, it brings the masses with it.
It's a bit like Facebook and Meta, right? And it's that second mover advantage, if you like. It doesn't have to be the first mover at things. If it moves better a little later on, well, it'll still pick up those clients. And I mean, Apple is trading at a nice valuation here, $227.60, and obviously before earnings, people are expectant, or they're, bidding up this stock.
Yeah, and of course, we'll be waiting to see what kind of numbers they show for the latest iPhone 16, as well as the latest other wearable devices like smartwatches and AirPods. Again, Apple results just crossing right now, and what we can tell you is that the fiscal fourth quarter revenue does meet analyst estimates, $94.93 billion. Analysts were looking for $94.36 billion, so a little bit higher than anticipated. Fourth quarter EPS 97 cents compared with $1.46 a year ago. So that is a drop in profitability. iPhone revenue, which is, of course, the lion's share of overall revenue for the company, $46.22 billion. Analysts were looking for $45.04 billion. Greater China is something really of importance to investors here, because Greater China makes up 17% of total revenue over at Apple. It's almost a play on China and the Chinese consumer in some ways. That came in at $15.03 billion. That was a miss. Analysts were looking for somewhere in the neighborhood of $15.8 billion when it comes to Greater China revenue.
Yeah, a little weakness in Greater China, although, that's not a huge amount weaker than analysts were anticipating. They were looking for $15.8 billion, and we are getting stimulus. And, some of that stimulus might go on Apple products. But as you say, perhaps a little bit more concerning are things like, iPad revenue being a little bit weak, Mac revenue coming in exactly at the estimate, wearables and home accessories, that also missed estimates. But it's saying that its active installed base of devices did reach an all-time high. The iPhone revenue, as you say, also beat. So it's a mixed report, some good news and some bad news for Apple. And as you can see, investors are sending this stock all over the place in late trading. But right now, we're down about 0.9%.
Yeah, and of course, what's going to be extra important is the commentary on iPhone 16 and how that's doing and what kind of visibility they have into the current quarter, which is the all-important holiday season quarter as well. Let's bring in our guest right now, who is Daniel Flax, to give us a little more analysis on Apple. He's a senior research analyst over at Neuberger Berman. Daniel, you listened to the numbers that we just went over. What jumps out at you in terms of the results that doesn't really have investors, convinced to either push the stock up or to push it down?
Good to be with you. I think what we're seeing is that the iPhone franchise remains durable. What's important is that the install base there is continuing to grow. And over the next several months and into next year, we'll see how Apple Intelligence helps to evolve the experience. I think services is healthy. And really, it's this continuation of the broadening of the growth drivers that we see. Apple is navigating what is, of course, a very difficult environment. I think they're executing well on their product cycles, which sets them up for better growth over the next 12 to 18 months. So we continue to like the name here.
Sure. How concerned does Apple have to be about China revenue, again, coming in at $15.03 billion versus the estimate for $15.8 billion, Daniel?
China remains a very important market for the company. The install base there has continued to grow. The ecosystem there, I think, is vibrant. The Chinese economy is under pressure, and Apple, given its size, is of course, having to deal with that, as are others. When we look out over the next 12 to 18 months, I expect Apple Intelligence will become available in China. I think that will help drive improving growth in the iPhone install base and, of course, the iPhone revenue as we think about the opportunity there. The other key thing is the services business. I think that remains healthy in China. That is becoming more and more important to the overall Apple story. And of course, you have more recurring revenue. And so pulling all of that together, you have a company that generates over $100 billion of free cash flow a year and is continuing to grow that number. So we like what we see, of course, appreciating the cyclical dynamics. And of course, China remains difficult.
Yeah, and that's obviously not limited to Apple, but to companies all around as well. You talk about the free cash flow and that mammoth number. We should mention that Apple is applying some of that free cash to its dividend. It's declared a cash dividend of 25 cents a share, which is basically maintaining it at that level. How else should Apple be spending that cash, Daniel? Should it be spending more on AI? Is it not spending enough?
The company's been investing in artificial intelligence and machine learning for many years, and that's found its way into the products, everything from the iPhone to wearables, which I think remains a very interesting and exciting opportunity over the next couple of years as they infuse more health and fitness capabilities. What's important is that this company is really about empowering the developers. Apple has paid out over $300 billion to the developers since they opened the App Store over a decade ago. And so I think the most important thing is to invest in the products, invest in the developer ecosystem, empower others to be successful and build on their platform. If they're able to continue to do that, I think they're going to successfully extend into new markets. And I think Apple Intelligence will help to evolve the experience and make it a richer, even more engaging and differentiated experience. That will take time to play out. But the key, in my view, is really to get the experience right. And it's about integrating hardware, software, and services to deliver a private, secure, and fun user experience, which ultimately helps to drive growth for the company.
Dan, what would be the burning question you'd want asked on the call?
I'd like to get a little bit more color, and I'm sure we'll hear about the very, very early days of the iPhone 16 cycle. And so we'll hear a little bit more from the management team about that, and also how they're thinking about the rollout of Apple Intelligence over the coming months. The key, in my view, is that the company has to continue to be deliberate, thoughtful, and really navigate a lot of these technology transitions, which they've been able to do very successfully over the last several years. And when I think about the second half of the decade, which is really our focus, I expect continued innovation, new products, new services, and I think that will help propel attractive growth rates for the company from a revenue standpoint, and then strong free cash flow generation as I think about the next 12 to 24 months.
Good stuff. Daniel Flax, Senior Research Analyst at Neuberger Berman, thank you so much for the initial analysis here on Apple's latest quarter. Clearly, it has been a mammoth week for big tech. Meta, Microsoft, Alphabet, and Apple all delivering results. We're pretty much done with the Mag 7, except for NVIDIA, which comes out a couple weeks later. But we want to wrap this all together now and bring in Daniel Newman, who is CEO of the Futurum Group, to give us kind of an overall take on what he's seen so far. Daniel, great to see you on set. Thank you for joining us.
Thank you.
How would you grade this quarter for the big tech companies if you had to give it a letter grade?
Yeah, I think there's some really positive acceleration. I'd say like B+. The Google number got off to a good start. Mm-hmm. The 35% growth, the $2 billion in profit. You know, there's still some questions about AI. Like the iPhone number looks really good, but there's been a lot of sort of skepticism about the delays or the orders being slowed. And are people going to use intelligence? Because I'm kind of calling it semi-intelligence right now.
Mm. Well, they only just started rolling it out, so it's still early days for this company. But when it comes to Apple Intelligence, it doesn't have to do a whole lot different than what's already out there. But once it actually gets the critical mass behind it, that's where it can really move numbers, right?
Yeah, so Scarlett, I talk a lot about this elongated sales cycle. You heard about the super cycle. Mm-hmm. And I don't know that that's it. I think we're going to see the longest growth sales cycles that we've seen in the past, because now what's going to happen is new features hit, and then people are going to see their friend, and there's going to be that kind of FOMO of, oh my gosh, I'm seeing this new email generation tool that works really well. Because a lot of these things we can kind of do now with cloud services or with apps themselves, but we've all really wanted a smart Siri. So a real smart, better front end with Siri could start to get people off the couch and into the stores.
You pointed out it's been the same the last 8 quarters, it feels like, the same setup going into earnings, you know, and except really for the previous quarter to this one, right? Yeah. We are getting the same kinds of reactions. When will investors tire of this theme?
Well, a couple of good things did happen in the last 24 hours. I think Microsoft having that $10 billion number where they're saying their AI business, I think I was getting tired, and I think many investors were getting sort of tired of this. NVIDIA was the only company that could descriptively tell what their AI number was. Everyone else, it felt a little bit loose. We saw some encouraging progress from AMD, pushing up that number just a little bit. I think people would like to see more, but they're pushing it up a little bit, the story. I think, though, that, AWS, Microsoft, Google, their cloud growth, Vani, is really an indicator of AI adoption. So we're starting to see the other side of this. And I think that's what investors need to see to be confident, because we're already at high, the prices on these stocks are already really high.
They're high, but also, again, I think I said this earlier, we're not sort of at the valuations that we saw in 2000 or late 1999, right? So it's possible they could stay this high, I guess, for some time. But at what point, will investors revalue these companies, and will it turn to sort of very specific things like the energy companies that are going to power the AI, the data center providers that are going to provide the data centers?
Well, look, there's so much strength in the Mag 7. Effectively, their balance sheets are so strong they can buy their way into anything. I mean, for a decade now, Google's been building silicon, chips, brain, DeepMind. They had all this, and so this inflection has worked really well for, say, Google, Microsoft. Microsoft bought its way in with OpenAI, and of course has built around that. AWS had the market saturation. Apple has been the laggard, and that's been an interesting one. Partnering with Google actually on the TPU is really interesting. They are not going to go the NVIDIA path, which I think surprised a lot of people. And of course, NVIDIA has a ton of room to run. Our market forecasts are showing plus 30% in CAGRs, and we've seen forecasts on AI and GPUs and AI chips over 60% hit the market. So there's still a lot of enthusiasm for growth.
How do the latest sets of the Mag 6 results set things up for NVIDIA, which reports in a couple of weeks?
Well, I think everyone's eyes on the CapEx, right? And so we've kind of heard this horizontal CapEx. I mean, I think Facebook lifted the bottom of their range a little bit. Microsoft kind of showed a bit of continuity, but at the same time...
So you're safe if you just keep it stable?
I think it's a little stable here, but we also hear things from like TSMC, CoWoS, 3 nanometer. These are the nodes where all the AI chips are being built, and they're sold out for year, 2 years. Same with the HBM, that memory that everyone has talked a lot about, sold out in many cases 1 year, 2 years down the line. So that means the demand is palpable, but these 1 year cycles, Scarlett, this is unheard of in chips. Historically, compute cycles are multi-year. So the fact that these cloud providers need to keep pouring money into CapEx. And then, Devani, your point, you talked about like real estate and energy. I think there's going to be a lot of enthusiasm there because we simply can't meet capacity. So if you're playing those adjacencies, that's another area to look at.
So if there's this much demand and you see this kind of continuing, what does that mean for talent and employment at a lot of these firms? I know that you spend a lot of time talking to CEOs of companies in Silicon Valley. What are they telling you?
Yeah, in the last few days, I've talked to Pat Gelsinger, Lisa Su, Bill McDermott. They're all very bullish. I mean, of course they are. They're tech CEOs in a tech bull run.
That's in their DNA.
But having said that, I've got kind of these two philosophies. There's one philosophy that I believe we're going to see a bit of a prune to grow. Job numbers in the Silicon Valley in 24 are the same as they were in 2019. So these companies have pushed earnings, pushed revenue, and done it without a lot of net ads. At the same time, I think we know in every digital revolution, there's always this sort of scare. We thought it when the assembly line came out. Oh my gosh, we're not going to need anybody in factories anymore. And look, we actually have more people in factories. So I'm still optimistic about it. Having said that, this agentic AI and what we're doing with these digital assistants, incredibly powerful. Jobs like business analysts that used to be able to, have to, go through tons of research to find outputs and provide inputs to your executives. This can be done in seconds now. Companies like Salesforce, ServiceNow, Microsoft. I'm really excited about this, but what do those people go do?
Exactly.
It's not clear yet.
So our own Ed Ludlow is going to be speaking to Pat Gelsinger live on air in just a little while, but I know you spoke with him, as you just said, recently in Silicon Valley in the last couple of days. What do you make of this quarter and what Pat Gelsinger is trying to do in order to somehow save this company in some way?
Well, first of all, it's good that the market saw through the numbers and were able to see with the impairments taken out that the quarter was actually much better. Having said that, I mean, this is a long multi-year turnaround. I don't think Pat ever said it wouldn't be, but I think his enthusiasm, he's a very energetic CEO, and his early enthusiasm, I think people were hoping it could be done even faster. Foundries take a long time to build. Getting the customers into foundries takes a lot of time, but you've seen wins with Amazon, with AWS, wins with Microsoft. So that's been really encouraging. I mean, of course, AMD's data center business, Vonnie, grew 122%. Intel's grew 9%. People are going to want to see that number go faster, but they've done pretty well in AI PCs. They have to win an AI chip, though. They have to get some strong momentum. They have this Gaudi 3, but the whole market is really riding on, can they be a big player in AI in the data center? I think they can do it technologically, but this time that's gone on with NVIDIA gaining share and AMD gaining share, it's going to get harder the longer it goes on.
So does the funding from the CHIPS Act, the support, the federal support from the White House, help them get towards that goal?
Well, I think it's twofold. I think the biggest advantage for Intel with the CHIPS Act is the foundry business. I believe the risks in Taiwan, the complications between China and Taiwan, give reason that we really do want a strong U.S.-based company to manufacture chips at the leading edge here in the U.S. If you look right now, TSMC is doing great here, but TSMC is still a Taiwanese company that has all the complications. So a lot of that money, I think, is about being able to make the most advanced semiconductors here in the U.S. by a U.S. company. And if they can get even 5 or 10% of market, that's billions of dollars of revenue. And I think to some extent, policy could force the hand of some of these fabless designers in the U.S., the Qualcomms, the AMDs and NVIDIAs, to do more with Intel, and that would be a huge win for them. But they do need to prove that the products work as well. There can't be a technological disadvantage to fab with Intel, and that's the question mark. Early indicators, though, they are doing better, I think better than expected, on a better timeline than expected.
All right, well, we'll see what Pat Gelsinger has to say to our Ed Ludlow when he speaks with him later on this afternoon. Daniel, always appreciate your joining us. Daniel Newman is CEO of the Futurum Group, giving us his take on the big tech earnings so far. And let's just give you a recap here of what happened in after-hours trading. Intel shares moving to the upside by 9.8%. It was a third quarter that was pretty much mixed, but it did make some announcements. It is cutting more jobs. It is taking a big impairment charge, $3 billion of restructuring charges. And from a low bar, Intel did beat a couple of metrics there for its third quarter. As for Amazon, that stock moving up by about 4.2%, projecting strong sales and profit for the holiday shopping season. Third quarter net sales also beating analyst estimates. This is the close on Bloomberg. All right, Apple reported earnings about 14 minutes ago, and we're keeping you posted on what's going on. The shares are down in after-hours trading after reported fiscal fourth quarter revenue that did meet analyst estimates. In fact, it did exceed it a bit, but China sales not doing as well. So let's bring in Ed Ludlow, Bloomberg Technology co-host. Ed, do we chalk this up to what's going on in China, or are there more concerns percolating?
Yeah, it's simply a case of learning definitively from the executives, whether it's Tim Cook or outgoing CFO Luca Maestri, whether iPhone grew in China. So the summary is really simple. Apple grew in every market around the world overall, apart from in Greater China, and iPhone revenue beat expectations. The piece missing is how did iPhone do in China specifically? And I think, Scarlett, you and I talked about this a bit this week, right? There is third-party data that we treat with caution that would suggest that the consumer in China bought the iPhone 16 in anticipation of Apple Intelligence, the AI tech, being released at a later date, even though it's not available there now because the regulator doesn't permit it.
How much is there concern being built into the stock price, which, by the way, is not that far off a record? We should point that out.
Right.
But how much concern about Apple Intelligence is being built in here?
I know, for like all the drama that happens like all the time, a percentage point decline in after hours is like, I think all of us are sighing a bit of relief. I think that, this has been a year where sweeteners for investors have played a really big role in quarterly earnings, right? Companies have either been looking to the dividend or to the buyback program, either for the first time or expanding it. Now, they generated Apple $27 billion of operational cash flow in the quarter and were able to return an equivalent amount to investors, but that's not doing much to support the stock. I really think it's just an iPhone story, and the only way you're going to get more on that is to tune into the analyst call.
Yeah. Good tease ahead, Ed Ludlow. Thank you so much. Bloomberg's Ed Ludlow is a co-host of Bloomberg Technology, and we'll be checking in with him later on when he does speak with the Intel CEO. Meantime, let's stay on Apple because questions over Apple's AI strategy will hover over the earnings call. And for more on what exactly the company is doing and how it's all shaking out, we want to bring in someone with a deep understanding of the company, its culture, and its innovation, and that is Steve Wozniak. He co-founded Apple alongside Steve Jobs decades ago. Steve, such a pleasure to speak with you. Thank you so much. You are a former Apple insider. You're a current devoted Apple user. We know that. And the initial version of Apple Intelligence was made available through an iOS update to iPhone 16 and iPhone 15 Pro users. I know you've praised the demos. Have you gotten a chance to test out the new software? And if so, what do you think of it?
Yeah, I just installed, along with everyone else when it wasn't beta, the iPhone update. And I tried a few little like Siri searches, Siri questions to look for data. And I made them a little more complicated in my wording than Siri normally gets. And they worked fine. So maybe it was better. I couldn't tell you for sure. I like to use things for a long time before I really comment on, are they good? Are they worthwhile? This and that. I mean, once in a while I can tell right away. But not yet here.
Not yet here. Okay, so there's still a lot that you're going to play around with. How does that compare with how you use Apple or Apple tools or any AI tools right now in your daily life? I'm just trying to get a sense of how you anticipate using Apple AI tools to enhance what you need to do right now.
Yeah, I pretty much avoid large language models because I want things to be really that I know it's accurate, like something works rather than it didn't work. And I don't like to be surprised. I want to think about everything that I read or hear and really think it out and that I understand it and can express it in my own words. That's AI, actual intelligence.
Well, that's just it, Steve. Not everybody is, jumping on board the AI bandwagon. Is Apple going to cater to those people that don't care about AI, almost would turn it off if it was on their phones, to ensure that they will continue to upgrade each cycle?
Oh, I think most of us are on an AI bandwagon and appreciate it very much, but of lightweight stuff. I mean, like, we've had AI for quite a while. The highest intelligence of how computers can think out and predict what you're going to want in your life, kind of like our old knowledge navigator going back, 30, 40 years. It was like a little demo we made up of what computers could do if they could really think. And we're moving closer towards that, but the inaccuracies, does it really help you if it doesn't create? It just repeats things. So it's a very good search engine for me. It finds things on the web. I wish it had citations that you could click on any item that came back to you from AI and say, or just question it verbally and say, where did this come from? And let it tell you, just like all the citations in scientific journals that advance our knowledge.
So, as you know, Steve, Apple hasn't always been very first. It hasn't been the very first at certain things, but it usually ends up being the best at something. What would you advise, the current team to do in order to be the best at AI?
I don't know, have the best testing you can. Apple already shows that it cares so much about the employees and the users, and diversification and and also not tracking you, being a little more private than the others. So I think that's a good sign that Apple is going to pay attention to, not taking advantage of you with AI. And largely, though, it's up to the user. I think a lot of user education should come along with this.
Yeah, Apple has definitely made privacy one of its differentiating points when it comes to its innovation, especially when it comes to AI. Do you think overall, just taking a step back as we talk about these earnings from these big tech companies, that investors and financial markets overall are impatient when they punish companies for spending too much on AI and not having enough to show for it in terms of, a monetization or some kind of tangible return?
Well, what comes in the form of AI and how good it is really created by the upper executives in a company. But the trouble is the upper executives in a company don't exactly own it. It's all the little shareholders like you and I and others and investors. And so they're watching every little report and everything and turn the stock up and down. Apple is a little bit, and I do recognize the problem of iPhone being kind of the major product. We're sort of closer to a one-product company. There were times with the Apple II, we were a one-product company. There were times with the Macintosh and even a Fortune, 500 company way up on the list, like Fortune 20, our stock would drop by a third in one day sometimes, and you didn't have a backup of a lot of other products, like the Apple services and Apple Pay and all that to kind of balance things out a bit. So that is a concern that I do agree with. Got to keep your eye on it. But Apple's still doing a good job for the Apple community.
Well, exactly. And for investors, Steve, I wonder what kind of a job you think Apple is doing. You've been around, the financial world a long time. Is the price at $225? There are 39 buys, and many of those price targets are higher. Is it trading at a good valuation in your estimation?
Yikes. I'm a user type person, not an investor. I have never used Apple's stock app. When I was 18 to 20 years old, I came up with a formula that, I'd never be political and never vote, but also that I wanted to be happy in life, and that meant smiles minus frowns. If you're constantly watching something go up and down in stock or valuation of this and that, you're not going to be that happy, So I just like to let my head run nice and smooth. That's just me. And I like to observe things and be an observer and obviously be affected by things, but I just can't get into that.
So ones and zeros, but that's where it ends.
About this is
ones and zeros in a different way, right?
Exactly.
Steve, really appreciate your joining us.
Smiles minus frowns, and I like to avoid frowns.
Okay, sounds good. Steve, we'll leave you to it. Steve Wozniak is co-founder of Apple, giving us his take on Apple and its AI journey and the Apple intelligence tools, which, Vonnie, for now, so far has not really, taken hold with users just yet because they're a little bit late to the party when it comes to it.
Correct. And also people are just buying their iPhone 16s now, right? And there was a lot of talk this week about the new Macs, the MacBook Pros, the Minis, and so on. We'll see. Maybe we'll be saying a different thing at the end of the year.
We'll see how the stock trades as well when the earnings call begins. Right now, it is lower in after-hours trading. That does it for us. Balance of Power is up next. This is Bloomberg.